Welcome to the Westside Investors Network, WIN, your community of investing knowledge for growth. This is the Real Estate Professionals Investing Podcast for real estate professionals by real estate professionals. This show is focused on the next step in your career, investing. Thank you for listening. And please, if you like our content, rate us on your podcast provider. Just a quick disclaimer, the views and opinions expressed in this podcast are for educational purposes only and should not be construed as an offer to buy or sell any shares or securities, make or consider any investments, or take any other action.
Welcome back to another episode of the Deal Deep Dive segment on the Westside Investors Network podcast. I'm your host, Trent Werner. In this segment, our featured guests will share their unique stories on a specific deal they've invested in. We will dive deep into finding the deal, financing the deal, writing an offer, and the due diligence. Do us a solid and smash that subscribe button, leave us a rating, and share this episode. And now, let's dive deep. Welcome back to the Westside Investors Network podcast. I'm your host, Trent Werner. On today's Deal Deep Dive episode, we're joined by Charles Seaman, Cash Flow Champs. Charles is going to share about his career and how he got exposure to commercial real estate and running businesses as young as 20 years old in New York City. Charles then took a leap of faith and moved to North Carolina to go all in on real estate multifamily syndication. We're going to hear about a 64-unit townhome deal in Charlotte, North Carolina, and all the trials and tribulations with it. Now let's welcome Charles Seaman. Charles Seaman, welcome to the Westside Investors Network podcast. Thanks for joining us today.
Trent, thanks for having me on.
So Charles and I are going to talk about how he went from wearing all the different hats in terms of real estate business management to now wearing all the different hats in syndication and multifamily management, and hear about Charles's deal in North Carolina. We'll get to that here in a little bit. But Charles, where did your career start off? I know it wasn't specifically in syndication, but it was in real estate in some capacity. You want to share a little bit about your background?
Yes, absolutely. So I probably took a little bit of an unconventional path to get to where I am. My commercial real estate exposure started when I was 20 years old, and what I tell people, I say jokingly, I was young, dumb, broke, and I needed a job. And I wound up finding a position that allowed me to gain exposure and access to a lot of different industries, and one of those was commercial real estate. So when I started that position, it was 2005. I was working for a very successful, serial entrepreneur, for lack of a better term, in New York, and I was pretty much his right-hand man. So that gave me very close access to a guy that was very successful and an opportunity to probably learn way more than I ever would have in like an MBA program. So in that, commercial real estate was always the side that I really enjoyed most because that's what really spoke to me. And I knew that was eventually something that I wanted to be in. So I didn't know when I started the job, but I kind of gained that knowledge working there. Fast forward, a couple of years, when I first started there, like any job, especially at 20 years old, you're kind of on the lower side of the totem pole. But after a while, I gained a lot of trust and responsibility and moved up. So I wound up becoming in charge of running all of his different businesses and properties. And through that experience, I started making more money, started doing better for myself. And sometimes you kind of get lost along the way, because initially when I first started there, my goal was to stay there 2 or 3 years, go out and run my own business. And, as you start making a little more money and you start gaining more responsibility, sometimes you forget that path. So fast forward about a decade, now we're in 2014 and 15, and I'm thinking to myself, I always wanted to go out and do my own thing. What happened?
Yeah.
And, I started dabbling in single family. I would have preferred to be in commercial, but I also knew that I personally didn't have the budget to go out there and go out and buy commercial deals myself at that point. So I started dabbling in single family, started looking at wholesaling. And as I looked at those, I went out, I hired a mentor who I still have a good relationship with to this day. But I realized pretty quickly that it just wasn't the right fit for me. And for two reasons. One, I didn't like it. And two, I wasn't good at it. And part of it may have just been like, boy, I'm working on these big deals at work, and then I'm going out and doing these deals in my own time, it didn't excite me. And I took a step back, continued working my job, and then in 2016, for the first time, I heard about syndication. And when I heard about syndication in the past, it was usually associated with television or a good mafia story. But looking at this, I said, oh, this is pretty cool. So I could use the skills and the expertise I have. I can go out and do the deals I want, and I can go out and use other people's money. So that was something that was very attractive to me because it allowed me to be in the space that I wanted to be. And from 2017 on, I started actively looking for deals. Initially, I was doing that part time, about 10 to 15 hours a week while I was still working my full time job. And in June of 2019, I decided to take the plunge and go full time in syndication. And my thinking was, well, I've made some progress over the 2 years, but it's not nearly as much progress as I really want. I can keep going at the same pace and see what happens. But, jokingly, it would have probably taken me 10 years to close a deal. Or I can just go all in and see what happens. So now let me be clear. I'm not recommending this approach if you're brand new. Some people it works, some it doesn't. But I decided, okay, well, let's totally uproot my life, leave my job of the last 14 years, move to a different city because I wanted to focus on the business and be able to be closer to that market so I could really understand it and go all in. So that's what I decided to do. And that's kind of, fast forwarding to where we are now.
I love it. So you have an unconventional path in terms of, I guess, I mean, it is unconventional because you got a lot of exposure to real estate very early on, where I think a lot of other people that invest in real estate and get into syndications maybe come from different industries. They have a high paying W-2, are sick of it, and then want to get into real estate. But you also have a conventional aspect or a conventional path when it comes to starting in single family and then working your way up. I have a couple questions for you. The first one is, when you first started your job, obviously you got exposure to commercial real estate and all these other businesses. How come you didn't want to go be a restaurant owner or start a laundromat business or something like that and wanted to focus on real estate?
Great question. So admittedly, I did want to do those things, but I also knew that I lacked the capital to do them successfully. Now I guess I could have went out and found capital partners, but that thought never really crossed my mind at that point. And commercial real estate always gravitated to me. I think part of it was, for lack of a better term, the gamesmanship that you see. I kind of like the back and forth negotiation. It's almost like a real life chess game. It's like, okay, this guy moves here. Now what am I going to do to counter that?
I like that. Okay.
And that's something that's always really attracted me. I enjoy that part of it.
And then my other question was, you invested in single family real estate. Was that local to New York, or did you go out of state for that?
So it was actually in Philadelphia because when I first hired a mentor, I decided that it wasn't going to be a good fit to invest in New York. One, because of tenant landlord laws, but two, because of pricing, which just would have been very, very expensive. So it was more Philadelphia. That's really where I was looking at and where I was spending my time focusing.
And then you said that you weren't good at it in terms of single family investing, and it didn't pique your interest.
Right.
Why do you say that you weren't good at it? If you had all this experience doing these larger deals, you'd think that you could do the smaller deals pretty easy, right?
Great question. So, part of it may have just been my interest level. I'm sure that I could have developed the skills. So there are some fundamental differences between single family and multifamily, or really anything commercial. And the fundamental difference that I see is single family a lot of times tends to be very transactional, whereas commercial is very relationship based. And what I do really well, even though you don't put this on a resume or a profile, is I'm very good at building relationships and being able to leverage those relationships so both parties become successful with it. So in single family, you can do that, but not really as effectively because most times you're buying a one-off transaction from somebody. But in multifamily or commercial, whether it's a broker or a seller, a lot of times you're really working on that long-term relationship, and it's not just doing one deal together, but it's doing 5 and 10 and hopefully more deals together. And even like the deal we'll talk about today, that was the first deal I did with a broker I'd been building a relationship with for 2 years. But since then, we've done more deals. So once you close that first one and they see you as legit, for lack of a better term, they want to do business with you and they want to give you more deals because now it's like, oh, this guy can perform. We want to keep working with him.
I want to reiterate that because that's something that our business is solely focused in Oregon. We've been trying to get to other markets and building these relationships with brokers out there and trying to get them to take us seriously, even though we have a very solid size portfolio here. Is very difficult. And for all the listeners that want to get into syndication, I mean, Charles just said it doesn't happen overnight. He spent 2 years building a relationship with a broker before finally getting the opportunity to perform on a deal. But once you show that you can close, those brokers will run to you because they know that you're serious. They know you're not just wasting their time. And that takes, 2 years to get to that point.
Right.
So definitely, if you want to get started, you got to start now building those relationships in the
Right.
markets that you're identifying.
And they're going to test you and give you the bad deals first because they want to see if you stick it out and you keep coming back. So don't expect when you reach out that you're going to get the top-notch deal the first time or even the 10th time. They're going to test you with some real duds, and they're going to see, one, how much you know, and two, how bad you want it.
Yeah, and that's I have a buddy of mine's dad is a commercial investor here and is trying to get to the Nevada market, and they bought a place down there because he wanted to be closer to the market like you did, and he was building relationships. And he told me one time, he goes, I just have to buy a crap deal to show them that I can buy a crap deal, so they'll keep sending me something. And I think he ended up doing it, but like you said, they're testing you and trying to see what you know and how bad you want to get into that market.
Yeah, very true. Just a little tidbit, because it's funny you mentioned that. Well, two things I would say. So one of the biggest mistakes that I made starting out is for and I'm generally a fast learner, but I guess sometimes I can be stubborn. So, I have to see that something's going to fail before I realize that I can't just let people tell me it's going to fail. So, I didn't pick a target market when I first started. And classic mistake, right? Like everybody tells you, go out and pick a target market. Well, I said, okay, I'm not going to do that yet. So I was bouncing around. I was looking at deals in, my partners and I at the time, we were looking at anything east of the Mississippi River, which probably with a map, that's a pretty wide region.
Yeah.
So 1 month, we were looking at a deal in Ohio, 1 month in Indiana, twice in Kentucky. One of my partners went to Tennessee. And what we realized doing that, after about a year of doing this, we finally got smart and chose a target market. What happens is you don't have any relationships in those markets, because every time you're going into that market, you're the new guy and they don't know you and they're not going to vouch for you because, especially in the brokerage industry, their reputation means everything, because if they bring a seller, somebody that doesn't perform, that seller's not going to want to deal with them again. He's probably going to say some foul words about them. So, they want to be very selective that they're bringing buyers they feel confident in. And a lot of times the way you're going to build that confidence is just through repetition. You're going to have to go back and you're going to have to show them that you're serious, and eventually they start giving you a shot, but it's going to take some time to bring that guard down on their end.
Well, and to that point, so clearly your target market was Charlotte metro area. You moved there, and was that specifically for this business?
So the answer is it was. Interestingly enough, one of the things I've discovered is that Charlotte is ultra competitive. I kind of knew that already anyway, but I didn't realize how competitive. We've had a lot more success in the Atlanta market, ironically. But yes, that was really the reason I moved down, because I figured, how do you get to know the market better than living and working there every single day?
Yeah, and I would say, and well, I mean, I guess I've never done it, but I would assume that building those relationships is a hell of a lot easier living there than us flying in and out all the time. Anytime we want to go get lunch with a broker.
That was exactly my thinking. So, and there's truth to that. So a lot of times my greatest advantage is that I'm in the market. I make it a priority to see the brokers that I have good relationships with, usually every 2 to 3 months, and sometimes more, but, every 2 to 3 months, for drinks, for lunch, whatever it might be. There's a lot of times I've toured properties that I really didn't have interest in, just to get more face time in front of them. And now let me be clear, I wouldn't recommend flying across the country for that, but if you can do it in like a reasonable, 30, 40, 60-minute drive, sometimes it's worth the investment just to go build a relationship. And most of my deals have been worked out over lunch meetings. A lot of times you're like, okay, let's work out the terms. And like when you're having lunch, it just comes up in conversation, and all of a sudden, the broker or seller, if you're going direct to a seller, they're going to think, what do I have for this guy? And they'll say, how about this deal? Would you be interested in this? And most times my answer is yes, because, I never like to close the door before seeing what's there.
Yeah.
And then it's like, okay, well, if it pencils out, let's look, and then we'll put it on paper and make it work.
Well, so to kind of dive a little bit deeper on these relationships and the target market aspect, or I guess idea that we're talking about. You said you've had more success in Atlanta. I know that's
Yeah,
not 30 minutes from Charlotte, so
right.
it is out of state. How did you, I guess, start having more success there when you weren't living there?
Great question. So the first deal I did was actually in the Atlanta market. And while that wasn't really a market we were looking in, again, it came from a relationship. In this case, it was a sponsor relationship. And what happened is we had been looking at deals for a year or so, and we were working with this sponsor, submitting offers with him. He was very diligent about, working with us, which was great. But you could see we were serious. One thing I never did, and I would recommend this to anybody who's brand new: do not send sponsors garbage. If you do that, you're going to quickly be on their short list for going to spam and trash. So I always made sure that I always had my ducks in a row when I sent them stuff. And even though we didn't win any of those deals, and they were all in different markets before we really picked the target market, he knew that we were serious. He knew we were hungry. So in May of 2019, he came to me and he said, "Would you guys be interested in this deal?" And he lived in the Atlanta market. Almost all of his deals are in the Atlanta market. He owned a property management company that focused pretty much solely on the Atlanta market. So he knew Atlanta like the back of his hand. And, when we looked at that deal, I mean, keep in mind, the sponsor brought us the deal, not the other way around. It was a 92-unit deal. And at that point, he wasn't really interested in doing that himself because he was doing 200 and 300 and 400-unit deals. But he thought of us. And admittedly, my first thought was, when I underwrote it myself, it didn't make sense. But like many people when they're starting out, sometimes maybe you're a little too conservative on things. So then I looked at it with the sponsors underwriting, and I said, well, he owns 2,500 units. I have none. He owns his own property management company. I don't. And he's done X number of deals, and I'm still looking for the first one on the ownership side. So I said, maybe he knows something I don't.
Yeah. Yeah.
So we decided to run with his numbers, and that was our first deal. So as soon as you close that deal, you automatically have a little more credibility in that market, and then other people start reaching out to you.
Right.
So it's really through osmosis. It kind of worked out. It started with that one. And then even a lot of the broker relationships that I have in the Carolinas, many of them are with nationwide firms that have offices in most major cities. And a lot of times those firms talk. They say this buyer's good, this seller's good, this one's a pain in the butt. So just through osmosis, it kind of spread organically. And for whatever reason, there seems to be a little less competition in the Atlanta market, where we've had greater success actually winning deals there.
Interesting. Well, so like you said, all these people are talking, the brokerage firms that are national companies, global companies in some cases, they're all sharing stories, they're all talking. You close a deal in Atlanta, your target market is still Charlotte to this point,
Yep.
correct?
Correct.
All right. And we're going to talk about a deal in Charlotte. Was it your first deal in
So
Charlotte?
that was actually my third one.
Okay. So third deal in Charlotte, 64 units. What made you want to buy 64 units in Charlotte?
Yeah. Well, let me give a little clarity. So that was my third deal overall, but the first one in Charlotte.
Okay.
And now here's a word from our sponsor.
Get things done while you're on the move. Learn more about working with a virtual assistant through Offsite Professionals. It's a great way to get all the things done that you need to get done. Have freedom in your time and streamline your life by automating your business. Stop spending time on the tasks that you can delegate and start spending more time on your superpower. Call us today at 503-446-3177 or visit our website at offsiteprofessionals.com.
Uptown Syndication is now offering a syndication coaching program for you to take your real estate portfolio to the next level. This is your opportunity to have experienced syndicators, AJ and Chris Shepard, coach you on your way to controlling your real estate investing future. Our coaching program will provide you with the tools and framework needed to begin syndicating real estate in your target market. Go to uptownsyndication.com today to learn more.
So there was a few reasons. One, we got that property under contract in Q4 of 2020. So for anybody who remembers, that was kind of, a lot of uncertainty still with the pandemic. We didn't know what was happening. So there was a few things. One, it was in Charlotte. We've been trying to win something in Charlotte for a long time. We actually looked at that deal about a year before, but didn't want it. And then I happened to work it out at a lunch meeting with the broker. And I said, okay, well, let's make it work. What we liked about it was a few things. So it's literally a 7-minute drive from where I live. Now, the area I live in is definitely a much better area than where the property was. But being so close to the property, we could also see that gentrification is heading in that direction. Now keep in mind, for everybody brand new, gentrification doesn't happen overnight. So it's not gonna, you're not gonna buy there and then 6 months see a totally different area. It's gonna take time. So we knew that going into it, but we could see, okay, they're gonna be building a train line over here. It's in an opportunity zone, but it's an opportunity zone that has some development going on. So those are all things that are gonna start changing the area. And literally right next to the property itself, they were starting development on a 148 unit townhome community. So I was like, okay, well, these things seem pretty favorable, and if it was in a different area that I didn't live so close to, I probably would have reconsidered just because it was kind of a rough area. But being that I lived there and I could see that gentrification coming, it was like, okay, well, it seems like if we can get this at a halfway decent price, it probably makes sense because I think it'll just appreciate as the area improves.
And the 64 units that we're talking about are townhomes as well. So you kind of were able to compare classic townhomes with the new construction townhomes that were going on right next door.
Yep. And with the new ones, they were actually going to be townhomes that were sold off. So that was the developer's intent. They weren't going to be rentals. But it was like, okay, well, as soon as they build these, all of a sudden, our property will be a lot more valuable just by having that thing next door.
Absolutely. So 64 townhomes, what were the unit mixes? Are they all the same?
So the unit mix was 2 3s and 4s. There were 8 2-bedrooms, 28 3s, and 28 4s.
Okay.
Very unique unit mix. There's probably not too many multifamily properties that have a ton of 4-bedroom units. So that certainly gave us an advantage because for people with larger families that couldn't afford or didn't want the house, they were left with very few options to really pick from, and our property was one of them.
Very nice. And what was the price of purchase, if you don't mind me asking?
Yeah, so we purchased it for $7.4 million, right around $115 a door in February of 2021.
Very nice. And when was the property built?
So it was built in phases, 1966, 69, and 70.
Okay. And I'm assuming you had a value add plan going into a deal that was built 40, 50 years ago. 60
So
years.
admittedly, it was really just more an operational play. My favorite value add a lot of times, I look at it and say there's really 2 types of value adds. The first is going to be going in, putting a lot of CapEx, aiming to push rents. And the second to me is more an operational play. And what I looked at was that, well, what I liked about that property was a few things. One was just the area improving, but 2 was with all the uncertainty at the time, this property had about 70% Section 8. And like some people may look at that and say it's a bad thing. At one time I would have looked at it and said it was a bad thing. But the pandemic changed my thinking a little bit. I'm like, well, 70% sounds pretty good. I kind of like that certainty of collection every month. Just the rent hitting, on the 3rd or 4th or whatever it is of the month. And it's like, okay, well, you get a large part of the property collected in one big check.
Right.
So it was really more just operating the property, continuing to maximize the Section 8 vouchers we had in the area, and writing out the improvement in the area so that way we could capitalize on some of the gentrification.
So when you see 70% Section 8, I know it's a guaranteed rent or guaranteed rent, Are you able to increase those rents or if they're below market, get them to market as easy if it wasn't going to be Section 8 in Charlotte?
Great question. So the answer is yes and no. So you could often increase Section 8, especially if there's a gap from what the tenant's paying and what Section 8's maximum allowance is. But it's a lot tougher to do with an existing tenant than a new tenant moving in. So many times you need to be bringing some new tenants in to really capitalize on those, because a lot of times they're giving you like a cost of living increase on the year-over-year renewal, which is great. But if that renewal is going to leave you substantially below where their current max value is, you want to try and max that. So you do want to get some new tenants in there to leverage that.
Yeah. And so you're focused on operational improvement as we're talking about. Was there any operational improvement that needed to be done with the property management side of it? Or did you bring in your own property management company? How did you do that?
We did. Great question. So initially, it's funny when the seller was running the property, and now keep in mind, this is 64 units, so it's not a massive property. He had 6 guys on payroll, which is an absolutely astronomical amount. And he told me, he said, this is how he does charity. I said, I can see, because these guys are useless. I said, so we knew we weren't really going to keep most of them on because it just wasn't the right fit. And I said, I said, I'm not sure that we're ready to do that type of charity yet, but I said, I respect your initiative. So right off the bat, we knew we were going to make some staffing changes. When we first took the property over, we wound up using third-party management. But what we found is that after about 5 or 6 months, we weren't really happy with the results. And this is with a lot of management companies. It's not to single anyone out, but the thing is, a lot of times, especially on these properties that are, less than 100 units, it's tough to really get a lot of attention from them, and things always take longer to happen than you really want them to. So we worked out an agreement to, exit the agreement we had with them. And then we decided to bring it in first party and just have one of the partners had a first party company. So we decided to bring that in and have their team run it. So at that point, that definitely made a difference, because, you're watching the expense dollars a lot closer, even little things, so like the little things that people don't realize if they're not hands-on operationally, but like filing evictions on time, making sure that you're actually following up on promise to pays, because a lot of times, especially in C-class or lower properties, you're going to get promise to pays from different tenants. But some of those tenants will throw it out there very loosely just to avoid the eviction. If you don't follow up on them, they may never actually make good on it. So you have to really be diligent.
Yeah, no. And I heard one time at a convention, I was at the Best Ever conference, and one of the panels was saying in-house management is great because if you have third-party management, it's harder to get the managers to manage it like an owner. They're just managing it because they want the check every month.
Very true.
And what you just said is very true, because we have in-house management as well, and you're able to control the expense dollars, see what the managers are doing because you're hands-on and you're able to meet with them directly. You don't have to wait weeks or days to get reports from them. You can log into your own system and pull reports right away. It's a great way to go.
Yep, I agree.
So 64 units in Charlotte, Cambridge Park Townhomes is what we're talking about. We know the purchase price. We know the value add, plan that you were going to take or you took for this. What was the projected hold time, and how many investors did you have come in if you raised outside capital for this deal?
Yeah, totally. So with most of our deals, we usually project a 3 to 7 year hold. We like to give a range, and this one was the same. We usually do our underwriting on a 5-year hold just because that's what's kind of typical in the industry. Mm-hmm. We had about, I think about 26 or so investors in the deal. So a lot of which were international investors, which certainly helped. So they have a different threshold for what they're looking for a lot of times than the domestic ones. And, we wound up holding it right around 3 years. So we sold it actually February of this year, just a few days more than 3 years above when we bought it.
What was your projected returns on this when you were going into it?
So we had projected, a lot of times we like to give a range with different terminal cap rates because that's always such a big variable. But the most probable scenarios we were projecting between 16 and 18% average annual returns.
Which is solid. And I like how you're talking about AAR instead of IRR. I feel like average annual return is easier for anybody to understand, whereas IRR seems more fugazi all over the place.
Yeah, it's funny you mention that. I say that all the time. So I think there's a value in both of them, but you have to know the audience. Yeah. And for most of the people that are investing in these deals, I think even though they may talk about IRR, and even for most of the syndicators, for us, a lot of us can't really explain it. Mm-hmm. If you're a finance professional and if you've done that your entire career, it's a different story. But for most people, average annual return just makes it a lot more relatable.
Yeah, and 16 to 18% AAR seems very solid for a 3-year window, right?
Yeah.
So you sold it in 2024. Is that what you actually hit?
So we fell just shy of that. We were in the mid-15s on the average annual return. Still
solid. Was there anything you could have done differently with the deal?
So I don't think so. I think one of the challenges, and I guess this is with any older property, is you need to be really careful with estimating the CapEx. Because even if you're not planning to go in there and make improvements, things break, things go wrong. You have pipes that are old, and all of a sudden things need to be repaired. So we generally try to be pretty conservative, but there were probably some more CapEx expenditures than we anticipated. So we thought the time to exit was probably right. So overall, I think it was a solid deal, and I don't think there's too much we really could have done better there.
And I guess this is a question I like to ask people that are in different markets from where I'm at, or maybe there are listeners that want to get into Charlotte. So, projecting, I guess, more conservative CapEx on older buildings, that should be, kind of a given to some people.
Yeah.
In terms of expense ratios, what are you projecting and underwriting an expense ratio to be in Charlotte? If someone wants to get into there, what should they use for underwriting?
It's funny. I've always felt the expense ratio to be overrated. And the reason why is I think it's a simple metric, but I think a lot of times it's misleading. What I find to be a lot more effective is a per unit number. Now, the challenge with that is that's going to vary from market to market where the ratio can be kind of consistent.
Yeah.
But in Charlotte, what I would say, for a C-class property, so like one of the mistakes we made here is we thought we would need an on-site manager for the first 6 months, and that we'd be able to run it with no on-site manager after that. And for anybody who's out there, and if you haven't done a deal yet, a lot of times that sounds great in the theory, and with an A-class property, that could probably work fine. But when you're dealing with like a C-class or lower demographic, you need that on-site manager. It's almost like a babysitter. So that was definitely something like, okay, we should have factored that in all the way through. But I think, a lot of times you're probably going to be without payroll, 30 to 40%, I think is realistic. But once you get into payroll, 50 to 55% a lot of times for a rough number. But the per unit number, I think, will guide you a lot more, because where the difference comes in is the rent. And like what I always tell people is, well, think of it this way. If you own property A and you're charging your tenants $1,000, and the guy across the street owns property B and he's charging $1,200, is it going to cost you any less or any more to fix a leaky pipe? So the plumber's going to charge you the same price either way, regardless of the rent you're charging. Same thing with the staff a lot of times, right? So you're not getting a discount on a maintenance man because you charge less rent. Most times, sometimes you could, but then you're also probably getting a discount on quality and service. So I look at that per unit expense, and a lot of times for C-class properties in Charlotte, I think nowadays you probably want to be in that 6,000 to 6,500 a door range. That probably puts you in a good spot.
I like that. That's interesting. I'm going to have to look at our portfolio and break it down on a per unit range and see what the varying differences are from the different pockets that we have. Moving on. So we talked about, purchase price, hold time, all the different variables of the deal, the returns, some mistakes that you admitted to and are learning from going forward. Is there anything else that you want to share about this 64 unit deal in Charlotte?
I think that kind of sums it up in a nutshell. What I would tell for anybody listening here, there's 3 things I find that are common in the deals I've had that have went really well. You buy right, you finance right, and if the property is big enough to have on-site staff, you get good on-site staff. The properties I've been in that operate really well have those things in common. So those are really like your pillars, I feel like, when you get into these deals.
I remembered what I was going to ask you. So what is your threshold in terms of door count to say an on-site manager makes sense, full-time, you're not getting rid of them after 6 months? So
100 units would be that threshold. I think you can go as low as 75 units, but it's really going to depend on how well the property cash flows. If it's a property that doesn't spit out a lot of cash flow, it's going to be very tough affording that staff after 6 months or even at the beginning. But the closer you get to 100 units, the easier it gets.
Okay. Yeah, that's what I wanted to ask you, and I'm glad you mentioned on-site again, because I've always asked people that when we're talking just in normal conversation, and it's interesting to hear the different unit count that people think the on-site managers make sense. So 100 doors is what you would say.
Yep.
Okay, I like
that.
At
100 doors, it's a no-brainer. Less than that, it's really going to be dependent on how well the cash flows.
And you said 75 would be the absolute minimum.
Yeah. Now, in this case, even with the 64 unit property, one of the things that I think we often think when we get into deals, like as we're starting out, is like, oh, I should be able to manage this offsite. And even though the cash flow can't really support that staff, it's like, okay, managing it offsite is a lot tougher than you might think. And again, it depends on your demographics. So if you get that A-class property, you'll be fine.
Right.
But in the C-class property, you need that babysitter. That's what that on-site manager is, and you need them to go there and really knock on the tenants' doors, because some of these people, they're not going to pay, and you need to follow up. And it's routine that their phone service gets disconnected, so you need to go there physically and just knock on the door.
And so obviously we just talked about how your minimum number is 75, the 64 unit, you said it might make sense to have an on-site manager. If the 64 unit isn't cash flowing enough to support an on-site manager, have you ever considered giving them, a free unit and, maybe a smaller, I guess, salary on top of the unit to help make that make sense?
So it's funny you mentioned that. That's actually what we did at this very property.
Okay. All right.
Yes. So it is definitely a strategy. What I would tell anybody here is that when you have that lower paid staff, what you're also getting is lower quality a lot of times.
Mm-hmm.
And the challenge with it is how do you still maintain quality while not blowing the budget out of line? I don't think there's any perfect solution to it, but like one example I'll give for a different property, like we own the 48 unit property in South Carolina, and that property, by itself definitely could not have supported on-site staff. But one thing that worked really well is we found a management company that managed 3 of the properties in the area. And with all 4 of those properties together, there was enough scale to go out and get an on-site manager. And that way it didn't burden our property with the full cost. We just had, a portion of it for whatever she spent at our property. And each property contributed to whatever, she did for them. So it was like, okay, that was a good way to do it also, because at least you're still getting a quality manager who, who's competent and they care about what they're doing. And it's like, okay, you didn't blow the budget out. So sometimes you have to find that creative way, and you need to figure out, okay, how do I see a path forward here? And if you can't see that path forward, you're probably better off staying out of the deal.
Yeah. I love that idea. I love that. Well, Charles, we talked about your career, your business, the deal that we just covered in Charlotte. Is there anything else you wanted to share today?
So, I think this has been a great experience. No, nothing else to share at this one.
Awesome. And where can people hear more from you and connect with you?
Absolutely. So best way is going to be on my link tree. So I'll give you that so you can include that in the show notes, and that'll have all the best spots to find me. Awesome. We'll make sure we add that in there. Thank you, Charles. Likewise. Thanks, Trent.
Thank you for listening to this episode of the Real Estate Professionals Investing Podcast on WIN, your community of investing knowledge for growth. We hope that this episode has increased your knowledge and added value to your path to freedom. If you would, please take a second to rate us so that we can get more great investors to interview. If you or someone that you know wants to be on, please visit westsideinvestors.com and fill out our form to be on the show. Thank you again and enjoy your day.